Sugandha, equities, mutual fund, fixed instruments, riskier exposures, leave that aside. India and its fascination with gold, it's never going to go away. How is gold looking like as an investment opportunity in the year ahead?
Yeah, hi Siddharth. A very good evening to you and all the viewers. It's a pleasure to be here. Talking about gold at the time of festival season, obviously Indians have a lot of affinity for gold and it's a time-tested asset. I think it's every time is a perfect time to buy gold, and gold basically offers safety to your portfolio. Actually a diversification tool. So we cannot say whether buy gold or not. I think gold should be a part of every portfolio. But your allocation can be increased or decreased depending on the macroeconomic scenario. So if I talk about this year, I think the ride has been pretty bumpy. So at one point in time, the prices soared to a level of around 55,500 and levels of close to 2070 per ounce in international markets.
Yes.
But then after that, there has been a downward drift we have seen in prices. And so the last 6 months in the international market, prices are trading on the lower trajectory. But the domestic scenario is totally different, and we are seeing a totally divergent scenario in the domestic markets, wherein prices are down slightly, but then the rupee factor is providing a lot of cushion to gold prices at the moment. In spite of the fact that liquidity conditions are tightening, it's an environment of rising interest rates, which is actually playing a spoil sport and actually weighing on the gold prices, with greenback heading towards a fresh 20-year highs today as well. So all of these factors are certainly suppressing gold prices at the moment. But then I feel towards the last quarter of this year, demand is again going to be very healthy, as we have normally seen in the last quarter of every year, that demand picks up because of the wedding season as well as the festive season. Add to it that prices are trading at a significant discount to the record highs of around 56,000. So that's a perfect time to buy gold.
Right.
I would not stick my neck out and say that yes, prices have bottomed out.
Right.
But yes, there can be some more pain in prices of around 2 to 3% from these levels. But then it's certainly a level that you can start accumulating gold in a staggered manner. So at one level, if I talk about 48,800 is a good accumulation zone for gold. If we breach that level, yes, there can be some more pain in gold prices. But then if you look at a longer term perspective, if we talk about next Samvat and next Diwali, I think the outlook is fairly positive. It's basically the environment of rising inflation, which is...
Okay, let me hold you there, Sugandha. Let me hold your thoughts there, because we'll end up covering a lot of ground in the time that is left. Ajay, I'm coming back to you on the broader point, which is the difference in view and your call. Let me ask you about two things with regard to the Indian equity market. Stretched valuations, but that is something that we have been hearing for a lot of time, and you know, there are individual stocks which make your eyes pop out and you would question fundamentals. Yet, as far as inflation is concerned, I would argue that in the Indian environment, the pressure on the monetary authority and the fiscal authority is to continue to support growth. We cannot be a solely inflation chasing warrior like the US Fed. What impact does that have on equity, Ajay?
See, it's very simple. If RBI was sitting in an island, yes, there was no, you could do what you choose to do, and they did it. Actually, they've done it in the last 6-7 months. The Federal Reserve and everybody else has increased rates much faster than the Indian RBI. But now we reached a point where the difference between Fed interest rate and Indian interest rate, bank rate, is not 2.3%. And therefore, rupee at dollar at 81 rupees. If you need to get flows in this country, if you need to have a currency which is at par, or you'll keep losing your reserve at the end of the day, you need to take your interest rate up so that the parity between Indian interest rate and the US interest rates comes back to the last 10-20-year average, which is about 1.5% to 2% more.
Okay.
So, even RBI is now did what it did for whatever reason it did. But even like Fed Reserve realized that they were behind the curve, but they were much better than Indian RBI. We will see in the Indian policy, RBI will have to fast forward the interest rate, because now, given what's happened to the Bank of England, increase the rates, what happened in the US, what's happening everywhere, you have no choice. That's why the rupee you saw at 81. If India does not increase interest rates in parity with America, the dollar will become 83, 84, 85 in quick order, which has own series of implications on Indian economy. Therefore, I believe that RBI will do what every central bank has done, move the rates up. And as I think my colleague also said, when you talk about equity, 4% correction is a good point to come in as. Yes, absolutely. If market corrects by 5 to 6%, it's a good time to come in here, but you lose a lot of money. And on the point of default, just to assure most people that 90% of Indian investors who invest in bonds and this thing get their money back. ILFS is the story, leave it aside. But the fact is, if you invested in a Paytm, your money would be half in less on the day it got listed. So it's not that equity will give you only returns, and we have seen the returns have been muted in the last 2 years on equity, and mutual fund returns are in single digits now. So at the end of the day, we have lived in an environment of 6%, so we love the mutual fund return of 8%. That's going to change, gentlemen, changing and going to change fast.